Beloved seekers of truth, dear family of builders and protectors of wealth, there is a lie being told to millions of people every single day, a lie so carefully crafted, so perfectly disguised as wisdom that most people never question it. They trust it. They build their entire financial futures on it. And in doing so, they hand over their wealth to an industry that profits from their ignorance. Teach BATULIE, what if I told you that the moment you decide to trust your financial future to someone else, you may have just made the most expensive mistake of your life. Not because you're foolish, but because the game is rigged, and the house always wins. I'm going to tell you something today that will make some people very uncomfortable, very angry, in fact, because what I'm about to reveal threatens $1 trillion industry built on a foundation of carefully constructed deception. But you deserve the truth, and the truth is that the biggest lie financial advisors tell you isn't about numbers or strategies or markets. It's this: you need us. Let me take you back to a moment that changed how I understood the entire financial advisory industry. I was in my 40s, successful by most measures, and I sat across from one of the most prestigious wealth advisors in the country. Impeccable suit, corner office overlooking the city, walls covered with credentials and awards. He looked at my portfolio and shook his head with practiced concern. "You're taking too much risk managing this yourself," he said. "You need professional management. You need our expertise, our research team, our proprietary strategies." It sounded convincing. It sounded necessary. And then he showed me his proposal: a 2% annual management fee, plus additional fees for the funds he'd invest me in, plus transaction costs, plus. I did something most people don't do. I asked him a simple question: what have your clients actually earned after all fees over the past 10 years? The silence that followed told me everything. He stumbled. He deflected. He talked about risk-adjusted returns and benchmark comparisons, and a dozen other things that sounded impressive but meant nothing. But he never answered the question, because he couldn't. Because the truth would have exposed the entire illusion. His clients, after all those fees, after all that expertise, had earned less than they would have by simply putting their money in a basic index fund and doing absolutely nothing. They paid hundreds of thousands in fees over the years for the privilege of earning less than they could have earned for free. That's when I understood. This wasn't about helping people build wealth. This was about extracting wealth from people who didn't know any better. Now, before you think this is just about one bad advisor, let me tell you something that will shake you. This is the norm. This is how the entire industry operates. The financial services industry manages over $30 trillion in the United States alone. And every year, they extract hundreds of billions in fees from people who believe they need professional help to invest. But here's what the data actually shows. Are you ready for this? Over the past 15 years, approximately 90% of actively managed funds have failed to beat a simple, low-cost index fund. 90%. Think about that. You're paying someone with credentials, someone with research teams, someone with sophisticated algorithms and inside access, and 9 times out of 10, they can't do better than a fund that simply owns everything and charges almost nothing. But it gets worse, much worse. Those performance numbers, they don't even include the fees. When you factor in the fees that these advisors charge, the real underperformance is staggering. Let me show you the mathematics of this deception, because this is where the lie becomes truly devastating. Imagine you have $100,000 to invest. You're 30 years old. You're planning for retirement at 65. 35 years of investing ahead of you. Scenario 1, and you put that money in a low-cost index fund charging 0.05% annually. The market returns an average of 10% per year. After 35 years, you have approximately $2.4 million. Scenario 2, you hire a financial advisor who charges 2% annually, plus puts you in funds that charge another 1%. Same market returns. Same starting amount. But now you're paying 3% in total fees every year. After 35 years, you have $1.1 million. You didn't lose money, but you lost $1.3 million compared to the simple approach. $1.3 million handed over to the financial industry for doing worse than nothing. That's not a management fee. That's a wealth transfer from your pocket to theirs. And most people never realize it's happening because the lie is so beautifully told. They don't say, "Give us half your retirement so we can underperform the market." They say, "Trust us with your future. We're professionals. We have expertise you don't have. Investing is complicated. You need us." But investing isn't complicated. The industry has made it seem complicated because complexity justifies fees. The truth is beautifully simple. Own the whole market through low-cost index funds. Hold for decades. Rebalance occasionally. That's it. That's the strategy that beats 90% of professionals. But if everyone understood how simple successful investing actually is, the financial advisory industry would collapse overnight. So they must keep the lie alive. They must maintain the illusion that investing requires expertise, sophistication, professional management, and they've become masters at it. Let me tell you about the psychological tactics they use. Because once you see them, you can never unsee them. Tactic 1: manufactured complexity. They use jargon. They talk about alpha and beta and Sharpe ratios and modern portfolio theory. They make you feel like you're in over your head, like you couldn't possibly understand this without their help. But strip away the jargon, and they're just saying they'll buy some stocks and bonds for you, something you could do yourself in 15 minutes. Tactic 2: fear. They show you all the things that could go wrong if you invest on your own. Market crashes, concentration risk, sequence of returns risk. They paint investing as dangerous unless you have them to guide you. But they never mention that their guidance has historically made things worse, not better. Tactic 3: selective data. They show you their winners, the funds that performed well. The clients who did great, they bury the losers. They don't talk about the funds that failed, the strategies that didn't work, the clients who would have been better off doing nothing. This is called survivorship bias, and it makes their track record look far better than reality. Tactic 4: emotional manipulation. They become your friend, your trusted advisor. They take you to lunch. They remember your children's names. They make you feel cared for. And because you like them, you stop asking hard questions. You stop looking at actual performance. You trust, and trust is expensive. Now, I need to be clear about something. Not every financial advisor is intentionally deceiving you. Many genuinely believe they're providing value. Many are good people trying to help. But the system they operate within is fundamentally designed to extract fees, not maximize your returns. And even the well-intentioned advisors are trapped in a business model that profits from complexity and active management, even though the evidence overwhelmingly shows that simplicity and passive management win. Let me tell you about a woman I knew. Smart woman, doctor, earned a substantial income for 30 years. She trusted her financial advisor completely. He was recommended by a colleague. He seemed knowledgeable. She met with him twice a year to review her portfolio. When she retired at 65, she was shocked to discover she had far less than she should have. She'd been a diligent saver. She'd invested consistently. She'd done everything right except she'd paid fees, big fees, for 30 years. Her advisor had charged her 1.5% annually for management. Plus, he'd invested her in actively managed funds that charged another 1 to 1.5%, plus trading costs, plus transaction fees. All told, she'd paid somewhere between 2.5% to 3% every single year for 3 decades. When we calculated what she would have had if she'd simply invested in index funds and paid 0.05% annually instead, the difference was over $700,000. $700,000. Gone, not lost to market crashes, not lost to bad investments, lost to fees. She looked at me with tears in her eyes and said something I'll never forget. "He took my retirement." He smiled at me. He asked about my grandchildren, and he took my retirement. That's the human cost of this beautiful lie. Real people, real dreams, real security, transferred to an industry that convinced them they needed help they didn't need. And here's what makes me angry, truly angry. It's all perfectly legal, because the fine print protects them, because most advisors aren't held to a fiduciary standard, meaning they're not legally required to put your interests first. They just have to recommend investments that are suitable, not optimal, not best for you, just suitable. It's like going to a doctor who prescribes medicine that's suitable instead of what's actually best for your condition, because the suitable medicine pays him a bigger commission. You wouldn't accept that in healthcare. Why do we accept it in financial services? The answer is simple, because most people don't know it's happening. The lie is that good, the disguise is that perfect. But now you know. Now you see it, and you can never unsee it. So the question becomes, what do you do with this knowledge? How do you protect yourself? How do you build wealth without feeding this machine? That's what we need to talk about next. But first, you need to understand just how deep this deception goes, how the entire structure of Wall Street is built to profit from your trust and your ignorance. Because it's not just financial advisors. It's mutual fund companies. It's brokers. It's insurance salespeople disguised as advisors. It's an entire ecosystem designed to look like it's serving you, while it's actually serving itself. Let me tell you about the mutual fund industry. This is where the deception becomes almost artistic in its sophistication. There are thousands of mutual funds. Thousands. And every year they market themselves as the solution to your investment needs. They have professional managers, research teams, sophisticated strategies, and they charge for all that sophistication. 1 to 2% annually on average. Some charge even more. But here's what they don't tell you. Here's the dirty secret of the mutual fund industry. Most mutual funds don't exist to make you wealthy. They exist to gather assets. Because the more money they manage, the more fees they collect regardless of performance. A fund managing $10 billion and earning a 1% fee, that's $100 million in annual revenue. Whether the fund goes up, down, or sideways, they still get paid. You bear all the risk. They bear none. You lose if performance is bad. They win regardless. That's not a partnership. That's extraction. And the performance. Remember that 90% failure rate. That's over 1 year, 5 years, 10 years, 15 years. The longer the time horizon, the worse actively managed funds perform compared to simple index funds. But they keep selling. They keep marketing. They keep convincing people that this fund, this manager, this strategy will be different. And people keep buying. Because hope is profitable, because complexity sounds sophisticated, because we want to believe there's a secret that professionals know. But there is no secret. The emperor has no clothes. The performance data proves it, year after year, decade after decade. The simple approach wins. The expensive approach loses every time. Yet the industry continues. Billions in fees extracted annually from teachers, from nurses, from small business owners, from families just trying to build a secure future. And the people running these funds, they become incredibly wealthy. Not from investment performance, from fees on assets under management. They're not making money with you. They're making money from you. That's the system. That's Wall Street. That's the machine that convinced you that you need them. But you don't. You never did. Archite Theory of Deception. Now that you understand the lie, we need to go deeper. Because this isn't just about fees. It's about an entire system built on information asymmetry, on making you feel inadequate, on convincing you that wealth building is so complex, so dangerous that you dare not attempt it alone. Let me tell you about a meeting I once attended. A presentation by one of the largest wealth management firms in the world. They were pitching their services to high net worth individuals. The presentation was impressive. Beautifully designed slides, sophisticated charts. They talked about their proprietary investment models, their global research network, their risk management systems, their tax optimization strategies. It was designed to overwhelm, to make you think, this is beyond me. I need this level of sophistication. But then someone in the audience, an engineer by training, asked a simple question. What's your average client's actual return after all fees over the past decade? The room went quiet. The presenter smiled, and then he did what they always do. He changed the subject. He talked about how they'd beaten certain benchmarks in certain years, how they'd protected clients during certain downturns, how their high-touch service model provided peace of mind. But he never answered the question, because the answer would have destroyed the entire presentation. Their average client would have been better off putting their money in 3 index funds and never taking another meeting. This is the game. This is how it works. Dazzle with complexity. Deflect from results. Make it about everything except the one thing that actually matters. Are you making your clients wealthier than they would be without you? And the answer, for most of the industry, is no. But let's talk about why this matters beyond just the money. Because there's something more insidious happening here. Something that affects not just your wealth, but your entire relationship with financial independence. When you hand over your financial future to someone else, when you believe you can't do this yourself, you surrender power. You surrender control. You surrender the education that comes from managing your own wealth. And that surrender, that dependency, is exactly what the industry wants. Because dependent clients are profitable clients. Clients who understand investing are dangerous to the business model. I learned this lesson decades ago. I used to think that hiring experts for everything was smart efficient, the wealthy thing to do. But then I realized something profound. Every time I hired someone to handle something I could learn myself, I stayed ignorant. I stayed dependent. I stayed vulnerable. So I made a different choice. I decided to understand investing deeply, not to become a professional, but to become competent, to know enough that I couldn't be deceived, that I couldn't be taken advantage of. And you know what I discovered? Investing at its core is not complicated. The industry has made it seem complicated because complexity justifies fees. But the fundamentals are simple enough that any reasonably intelligent person can master them. You need to understand asset allocation. You need to understand diversification. You need to understand the power of low costs and long time horizons. You need to understand your own psychology and how to protect yourself from emotional decisions. That's it. That's the entire foundation of successful investing. Everything else is noise designed to sell you something. But Wall Street can't let you know this. Because if you knew this, if everyone knew this, the entire fee extracting machine would collapse. So they must maintain the illusion. They must keep you convinced that investing requires expertise you don't have, that markets are too complex for ordinary people, that professional management is necessary, and they've built an entire infrastructure to support this illusion. Let me tell you about the different types of financial advisors, because this is where the deception gets truly sophisticated, because not all advisors are the same, and most people don't understand the critical differences. There are commission-based advisors. These are salespeople, though they rarely call themselves that. They earn money by selling you financial products, mutual funds with loads, insurance products with commissions, annuities with massive built-in fees. Their incentive is not to help you build wealth. Their incentive is to sell products that pay them the highest commission. They're legally held only to a suitability standard, meaning they just have to recommend something that's not completely inappropriate for you. Not what's best, just suitable. Would you trust a car salesman who only had to sell you a suitable car? Not the best car for your needs. Who got paid more for selling you certain brands? Who wasn't legally required to put your interests first? Of course not. Yet that's exactly how most financial advisors operate. Then there are fee-based advisors. This sounds better, right? Fee-based, not commission-based. But here's the trick. Fee-based means they charge fees and accept commissions. They can operate under both models. So they might charge you for advice and then earn commissions on the products they recommend. Dual incentives, potential conflicts of interest everywhere, and most clients have no idea this is happening. Then there are fee-only advisors. These are advisors who only charge fees for their advice, no commissions, no hidden payments from product companies. This is better, cleaner, fewer conflicts of interest. But even here, the fee structure matters enormously. If they charge a percentage of assets under management, usually 1% to 2% annually, they have an incentive to keep your money with them rather than help you become financially independent. Because if you become financially literate enough to manage your own investments, they lose that recurring revenue stream. So even fee-only advisors operating under an assets under management model have a built-in conflict. They profit from your dependency. The only truly aligned model is hourly or project-based fee-only advice. You pay for specific advice, you implement it yourself. The advisor has no ongoing financial interest in your continued dependence. But this model represents a tiny fraction of the industry, because it's far less profitable than gathering assets and charging ongoing percentages. So the industry steers people toward models that maximize revenue extraction. And they make it all sound like it's for your benefit. Now, let me tell you about another layer of this deception, the performance reporting game. When financial advisors show you performance, They're incredibly selective about what they show and how they show it. They might show you returns before fees, making their performance look better than what you actually received. They might compare themselves to inappropriate benchmarks, a conservative portfolio compared to an aggressive benchmark to make their risk-adjusted returns look better. They might show you returns from a specific time period that makes them look good, while ignoring periods where they underperformed. They might show you gross returns without accounting for the tax consequences of their trading activity. It's all legal. It's all disclosed somewhere in the fine print, but it's designed to obscure the truth that you're paying a lot for results you could achieve better and cheaper on your own. I once reviewed a portfolio for a friend. His advisor had been managing his money for 15 years. The statements looked impressive. Lots of activity, sophisticated holdings, professional presentation. But when we calculated his actual compound annual return after all fees, it was 6.2% during that same 15-year period. A simple 3-fund portfolio of index funds would have returned 9.1% after fees. The difference. Over 15 years on a $500,000 portfolio. Over $400,000. $400,000 that went to fees and underperformance instead of his retirement. And his advisor, still sending him fancy reports, still taking him to lunch, still collecting fees, still convincing him that professional management was necessary. That's the system. That's how it works. That's the beautiful lie that costs millions of people their financial futures. But here's what you need to understand. This isn't about individual bad actors. This is about a system, a structure, an entire industry built on a business model that is fundamentally misaligned with client interests. Most advisors are not evil. Most believe they're providing value. Most are trapped in a system that pays them to gather assets and generate activity, regardless of whether that activity actually benefits clients. The system itself is the problem. And until you understand the system, you can't protect yourself from it. Let me tell you about the insurance industry's role in this deception, because this is where it gets truly predatory. Whole life insurance, variable annuities, indexed universal life. These products are sold as investment vehicles, as ways to build wealth tax advantaged, as solutions to complex financial problems. But in reality, they're some of the most fee-laden, underperforming, complicated products in the financial world. Products that make insurance companies and salespeople incredibly wealthy, while delivering mediocre returns to clients. I've reviewed hundreds of these policies over the years, and almost without exception, the client would have been far better off buying cheap term insurance for protection and investing the difference in low-cost index funds. But that simple approach doesn't generate big commissions. Whole life insurance policies pay salespeople commissions of 50 to 100% of the first year's premium, sometimes more. So guess which approach gets recommended more often? Not the approach that's best for you, the approach that's most profitable for the person recommending it. And it's all disguised as sophisticated financial planning, as wealth-building strategies, as solutions for high net worth individuals. But strip away the marketing. Look at the actual returns after all fees and charges. And these products are almost always wealth destroyers rather than wealth builders. Yet millions of policies are sold every year to doctors, to business owners, to people who trust the person sitting across from them, who believe that complexity must mean sophistication, that expensive must mean effective. But expensive usually just means expensive. Now let me tell you about the retirement industry, the 401k system, because this is where the fee extraction reaches its peak. Most people have their retirement savings in 401k plans, and most 401k plans are filled with high-fee mutual funds, with administrative fees, with record-keeping fees, with advisor fees. All of these fees, extracted from your retirement savings every single year, compounding against you over your entire working life. A study found that the average 401k participant pays fees of 1% to 2% annually when you add up all the different layers. On a career of savings, those fees can cost you 30 to 40% of your potential retirement wealth. 30 to 40%, not because you made bad investment decisions, but because the system is designed to extract fees at every layer. The mutual fund companies charge fees. The plan administrators charge fees. The advisors to the plan charge fees. Everyone is taking a cut. And you The worker trying to save for retirement, you bear all of it. And most people have no idea, because the fees are hidden, buried in expense ratios in fine print, deducted automatically before you ever see returns. You don't get a bill saying, "What charged you $8,000 in fees this year?" You just see your account value, and you assume that's how much you earned. But hidden inside that number is silent and invisible thousands of dollars were extracted every year. For decades. That's the retirement system in America. That's what we've allowed to develop. A system where the financial industry makes guaranteed profits, while workers bear all the risk and pay all the fees. It's criminal. Not legally criminal, but morally criminal. And the people running this system, they live in mansions. They vacation in the Hamptons. They send their children to elite schools, all funded by fees extracted from teachers and nurses and factory workers trying to save for retirement. That's the truth. That's the system. That's what we're up against. But here's the good news. The beautiful, liberating good news. You don't have to participate in this system. You have choices. You have power. You can opt out. Not completely. If your employer offers a 401k match, you should still contribute enough to get the match. That's free money that overcomes even high fees. But you can choose the lowest cost options in your plan. You can roll over old 401ks into low-cost IRAs. You can invest outside of these fee-laden structures whenever possible. You can educate yourself, learn the basics of investing, understand asset allocation, understand the power of low costs and long time horizons. You can become dangerous to this system. Dangerous because you can't be deceived, can't be sold products you don't need, can't be convinced to pay fees for performance you're not getting. That education, that financial literacy, is your greatest weapon against this machine. And it's not that hard to acquire. A few good books, sometimes studying the basics, a commitment to understanding before investing, that's all it takes. And once you have that knowledge, once you see how simple successful investing actually is, you become immune to the beautiful lie. You see through the complexity. You recognize the sales tactics. You understand that the person offering to help you might actually be the greatest threat to your financial future. That awakening, that's what I want for you. That's what this is all about. Not just protecting your money, but freeing your mind from a system designed to keep you dependent and confused. Because financial independence isn't just about the money. It's about the power that comes from understanding, from competence, from knowing that you can handle this yourself, that you don't need them, that you never did. TPHTOTREFILANDNC. So here we are. You've seen the lie. You understand the system. You know how Wall Street profits from your trust and your fear. But knowledge without action is just entertainment. Understanding without implementation changes nothing. The question now is, what do you do? How do you actually build wealth in a world designed to extract it from you? How do you navigate a financial system that's rigged against the individual investor? Let me give you the framework, the blueprint that works, the approach that has created more wealth for ordinary people than all the sophisticated strategies Wall Street has ever devised. And I'm warning you now, it's going to sound too simple. You're going to think I'm leaving something out, because you've been conditioned to believe that wealth building requires complexity. But that conditioning, that's part of the lie. Real wealth is built on simple principles executed consistently over time. Here's the truth that the financial industry desperately doesn't want you to know. You can build substantial wealth with 3 index funds, automatic contributions, and the discipline to do nothing for decades. That's it. That's the secret they've been hiding behind layers of jargon and complexity. 3 funds, a total U.S., a total international stock market index fund, a total bond market index fund. Allocate based on your age and risk tolerance. Rebalance once a year. Keep costs under 0.20% annually. Done. You've just built a portfolio that will outperform 90% of professional investors over the long term. But let me break this down because you need to understand why this works and why it's better than anything Wall Street will sell you. First, total market index funds give you ownership of the entire market. Thousands of companies, every sector, every size. You're not trying to pick winners. You're owning all of them and letting the market sort out which companies succeed. This is crucial because here's what decades of research has proven. Nobody can consistently predict which stocks will outperform Not professional analysts, not hedge fund managers, not anyone. The stock pickers who succeed in any given year. It's mostly luck. And next year, a different group will succeed. There's no persistence of performance. No way to identify in advance who will beat the market. So instead of trying to pick winners, you own everything. You guarantee yourself the market return, which sounds average, boring even. But the market return over long periods has created more wealth than any other investment strategy in human history. An average of about 10% annually over the past century. Not exciting, not impressive at cocktail parties, but absolutely devastating in its power when compounded over decades. The second reason this works: costs. Index funds charge almost nothing. Many charge 0.3% to 0.055% annually. Some charge even less. Compare that to actively managed funds charging 1 to 2%, or financial advisors charging another 1 to 2% on top of that. Those percentage points, they don't sound like much. But over time, they're the difference between wealth and mediocrity. Let me show you the math one more time, because this is so critical you need to feel it in your bones. Two people, both start with nothing at age 25. Both invest $500 monthly. Both retire at 65. Same stock market returns of 10% annually. Person A uses low-cost index funds charging 0.05% in fees. After 40 years, they have $3.4 million. Person B hires an advisor who charges 2%, plus invests in funds charging another 1%, 3% total annual fees. After 40 years, they have $1.7 million. Same contributions, same market returns, but person B has half the wealth of person A, half gone to fees. That's $1.7 million transferred from person B to the financial industry over their working lifetime for doing worse than nothing. Because remember, 90% of actively managed strategies underperform passive index investing. So person B paid enormous fees for the privilege of earning less. That's the cost of the beautiful lie. That's what trusting the system costs you. But person A, they understood. They kept it simple. They kept costs low. They let time and compound interest do the work. And they retired with twice the wealth. Not because they were smarter. Not because they took more risk. Simply because they didn't let the financial industry extract their returns. Now, the third reason this approach works: behavior. This might be the most important piece. The simple approach removes emotion from investing. You're not trying to time the market. You're not chasing performance. You're not panicking during crashes. You're not getting euphoric during bubbles. You have a plan. You execute it mechanically, month after month, year after year, through good times and bad. And that consistency, that emotional discipline, is worth more than any sophisticated strategy, because the biggest destroyer of investment returns isn't market volatility. It's investor behavior, buying high when they're excited, selling low when they're scared, chasing whatever performed well last year, abandoning strategies that are temporarily underperforming. This behavior, this emotional reactivity, costs investors 3 to 4% annually on average, according to research. More than any fee, more than any expense ratio. The simple, passive approach protects you from yourself, from your emotions, from the temptation to do something when doing nothing is the right answer. Wall Street knows this. They know that their sophisticated strategies don't actually work better. But they also know that humans crave action, crave the feeling that someone is doing something with their money, so they provide activity, lots of activity, trading, rebalancing, tactical allocation shifts, alternative investments, complicated tax strategies, all designed to make you feel like you're getting value for those fees, like something important is happening, but almost none of it adds value. Most of it subtracts value, because every trade has costs. Every active decision is an opportunity to be wrong. The passive approach embraces a profound wisdom, the wisdom of doing nothing. You're not smarter than the market. Neither am I. Neither is your financial advisor. The market aggregates the decisions of millions of participants, all the information, all the analysis, all the predictions, and it sets prices, prices that reflect collective wisdom, not perfect wisdom, but wisdom that you cannot consistently outsmart. So stop trying, own the market, accept the market return, and focus your energy on the things you can control. How much you save, how much you keep costs down, how consistently you invest, how you manage your behavior during volatility. Those things, those are where your power lies. not in trying to pick the next Amazon or time the next crash. Now let me address something important. Some of you are thinking, but what if I want professional advice? What if I have complex financial situations that need expertise? Fair question. And here's my answer. There are situations where professional advice adds value. Estate planning, tax strategy, complex business structure, specific legal questions. In those situations, hire expertise, but hire it the right way. Pay hourly or project-based fees for specific advice. Don't hand over your portfolio and pay ongoing percentages forever. Get the advice you need. Implement it yourself. Move on. A good fee-only financial planner charging $200 to $400 per hour can review your entire situation, create a comprehensive plan, and send you on your way for a few $1,000s. Compare that to paying 1% to 2% annually on $1 million portfolio. That's $10,000 to $20,000 per year, every year, forever. For that kind of money, you could hire hourly advice every single year and still save enormous sums. But that model doesn't build wealth for advisors, so they push the assets under management model. They make it seem like the only way to get advice is to give them control and pay ongoing fees. It's not true. You have options. You just have to know they exist and be willing to take responsibility for implementation. And here's what I've found over decades. Taking responsibility for your own investments makes you a better investor, because you're forced to understand, forced to learn, forced to become competent. When you outsource everything, you learn nothing. You stay dependent. You stay vulnerable. When you take ownership, you grow. You develop skills. You become dangerous to those who would prey on your ignorance. That growth, that's valuable beyond the money you save. That's personal development that transfers to every area of your life. Now, let me give you the specific steps, the actual implementation, because understanding principles is one thing, executing is another. Step 1, if you have a 401k at work, contribute at least enough to get the full employer match. That's non-negotiable. Free money that overcomes any fees. Within your 401k, choose the lowest cost index funds available, usually something called a target date fund or a total market index fund. If fees are high, contribute only to the match, then invest outside the 401k. Step 2. Open a Roth IRA if you qualify. This is one of the greatest wealth-building tools ever created. You contribute after-tax money now. It grows tax-free forever. You withdraw it in retirement tax-free. The power of never paying taxes on decades of growth cannot be overstated. Max this out every year if possible. Currently $6,500 annually, $7,500 if you're over 50. Step 3, within your Roth IRA, invest in index funds. You can do this at Vanguard, Fidelity, or Schwab. All three offer excellent low-cost options. A simple portfolio, 60 to 70% total U.S. stock market index, 20 to 30% total international stock market index, 10 to 20% total bond market index if you want stability. Adjust the percentages based on your age. Younger people can handle more stocks. Older people need more bonds for stability. But don't overthink this. Any reasonable allocation will work if you keep costs low and stay invested. Step 4, automate everything. Set up automatic contributions from every paycheck. Make investing something that happens without your involvement, without your decision-making, without your emotions. This is critical. Automation removes the psychological burden. You never have to decide whether market conditions are right. You just invest consistently, mechanically. Step 5, once a year, rebalance back to your target allocation. If stocks have run up and are now 80% of your portfolio, when your target is 70%, sell some stocks and buy some bonds. This forces you to sell high and buy low, to take profits from what's done well and deploy into what's lagged. It's counterintuitive. It feels wrong, but it works. Step 6, ignore everything else. Don't watch financial news. Don't read market predictions. Don't check your account daily. Don't let volatility affect your behavior. You have a plan. You're executing it. The daily noise is irrelevant to your 40-year outcome. That's it. That's the entire system. Simple enough to explain in a few minutes. Powerful enough to build multi-million-dollar retirement portfolios. No complexity, no sophisticated strategies, no professional management. Just simple, disciplined, long-term investing. Now, I know what some of you are thinking. You're thinking about the people who've made fortunes in the stock market. The Warren Buffetts, the Peter Lynches, the legendary investors. And you're thinking, If I could just learn to invest like them, I could do better than the market. Let me tell you something about those legendary investors. First, they're legendary precisely because they're rare. For every Buffett, there are 10,000 investors who tried the same approach and failed. Survivorship bias makes it look like stock picking and active management work because we only hear about the winners. We don't hear about the thousands who tried and lost everything. Second, even Buffett, the greatest investor of all time, tells his own wife to invest in index funds when he's gone. Not in Berkshire Hathaway stock, not in actively managed funds, in simple low-cost index funds, if the greatest investor in history recommends passive index investing for his own family. Maybe, just maybe, you should listen. Third, what made Buffett successful wasn't just intelligence or analysis. It was temperament, the ability to think independently, to ignore crowds, to stay rational when everyone else was emotional, to wait for years for the right opportunity. Those are rare qualities. Most people don't have them. And you can't learn them from a book or a seminar. But you don't need them, because you're not trying to beat the market. You're trying to match it at the lowest possible cost. And that anyone can do. The irony is beautiful. The approach that requires the least skill produces better results than the approach that requires the most skill. Simple beats sophisticated. Passive beats active. Low cost beats high cost. Patient beats active. Every single time over long periods. But Wall Street can't sell you simple. They can't charge big fees for telling you to buy index funds and do nothing. So they must maintain the illusion. Must keep you believing that investing is complicated, that you need expertise, that there are secrets that professionals know. There are no secrets. There's just mathematics. Compound interest, low costs, long time horizons, behavioral discipline. Master those, and you'll build more wealth than 90% of people who try to be clever. Now let me address one final piece, the emotional journey of this approach. When you embrace simple, passive investing, you're going to feel like you're missing out. Your neighbor will brag about the stock that doubled. Your coworker will talk about the crypto fortune they're building. The news will feature people making millions on options and day trading. And you're going to sit there with your boring index funds, earning your boring market returns, feeling like everyone else has figured something out that you haven't. This is the test. This is where most people fail. Not because the strategy doesn't work, but because they can't handle feeling boring, feeling like they're not playing the game everyone else is playing. But here's the truth, everyone else isn't building wealth. They're gambling, they're chasing, they're making the financial industry rich. You, with your boring approach, you're actually building something real, something that will compound over decades into substantial wealth. But it requires faith, faith in the mathematics, faith in history, faith in the process. Most people don't have that faith, so they abandon the simple approach. They start chasing, they start trying to be clever, and they lose. Not immediately, but eventually, because the house always wins. The system always extracts its fee. The gambler always gives back their winnings. But if you can stay boring, if you can ignore the noise and trust the process, you'll win, not spectacularly, not in a way that impresses anyone, but definitively, mathematically, inevitably. And 30 years from now, when you're financially independent and everyone who was chasing is still working, still stressed, still hoping for that big break, you'll understand. You'll see that boring was actually the most radical choice you ever made. That simple was sophisticated. That passive was powerful. That patience was profitable. That's the journey. That's the path. That's the truth that Wall Street has been hiding behind complexity and fees and beautiful lies. You don't need them. You never did. You just need to understand a few basic principles and have the discipline to execute them consistently over time. That's it. That's the secret they don't want you to know. Because if everyone knew it, if everyone understood it, the entire fee extracting machine would collapse. And the financial independence that they profit from denying you would become available to anyone willing to save, invest, and wait. That power, that's what I'm giving you today. Not just financial knowledge, but freedom. Freedom from a system designed to extract your wealth. Freedom from dependence on experts who don't actually help. Freedom to build your own financial future on your own terms. Take it, use it, and never let anyone convince you again that you need them to succeed. You have everything you need, right now, right here. The knowledge, the tools, the power. All that's left is the decision to use it.